You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome to the show, John.
Hey, Jim. So we got the Fed increase today that we have been hearing about for the past 3 or 4 years.
Last 3 or 4 years.
Yeah.
Well, they threatened it, and finally they came across with the threat. But going from 0% to 0.25%, is that a damaging blow to the U.S. economy?
No, it's meaningless in terms of fundamentals because, a quarter of a point doesn't make much difference in terms of any other interest rate besides the Fed funds rate. But it's symbolically important because they would like you to think it's because the economy is strong enough to handle rising interest rates. So in that sense, it's kind of a declaration of victory. But during the same day, actually during the same morning that the Fed was debating whether to raise interest rates, a lot of other numbers came out that were all pretty negative. I'll go through a few of them just very briefly, but oil tanked again. Now it's back down to its cyclical lows and looks like it's heading further down, which is that's a tax cut for consumers. So in that sense, it's a good thing, but it's a catastrophe for the leveraged speculating community because all these people who've borrowed money out there, based on the expectation of high interest rates, high oil prices, are going to be suffering going forward. So we're going to see a wave of defaults in the oil patch in the year ahead. And overall, that's bad for the global financial system. And meanwhile, a junk bond mutual fund went bust last week and refused to give the investors their money back, which spooked the market. And Yahoo Finance ran the numbers to see if anybody else is next, in other words, if any other mutual funds are in as bad a shape, and they came up with a long, long list, which they published this morning, of other mutual funds that are overstretched and in danger for one reason or another, mostly due to the junk bond implosion. So the junk bond funds that got into trouble last week are just the beginning, probably, of a long drumbeat of fund liquidations and bond defaults and other things related to the junk market that we'll be hearing about for at least another few months and probably for another year. Freight shipments in the U.S. went down, meaning that we're moving less stuff around, meaning that the real stuff, part of the economy, is weak. The Baltic Dry Shipping Index, which is a measure of demand for big container ships, has hit rock bottom. It's at the lowest level ever, meaning that we're not moving very much stuff between countries either. So global trade is shrinking. U.S. manufacturing contracted in the previous month, and U.S. industrial output went down. So add it all up, and the U.S. economy, and by implication most of the rest of the world, is not growing. And so that's usually an impetus for the Fed to cut interest rates. If they had raised interest rates earlier in the cycle, they might be cutting them now, but they feel like they've waited so long to raise rates that they have no choice but to do that. But based on the stats, it's probably exactly the wrong policy response.
Would higher interest rates in the U.S. finally convince people it's okay to start saving money again, or are the rates still going to be so low it still won't help? I mean, I think Janet Yellen said she'd like to see interest rates around 2.5% in a couple of years.
Yeah, well, if the economy kept on growing for a few more years, and the Fed raised interest rates incrementally every couple of months or every 3 months or whatever, we would get up there. But that's really unlikely based on the fundamentals of the global economy. We've already had a 6 or 7 year recovery. Interest rates have been at rock bottom for a really long time, and to the extent that there's any growth at all in the world, it's really tepid. And, as I just mentioned, a lot of indicators say it's negative. And so low interest rates didn't really work. So to raise interest rates, to the extent that lower interest rates generate more borrowing and more growth at the cost of higher leverage and more inflation in the future, but to the extent that it works in the short run to make an economy grow, raising interest rates would have the opposite effect. So I would say that it's highly unlikely that 2016 is a nice steady year in which we grow by 2 or 3% and inflation is modest, blah, blah, blah. That all the normal Goldilocks economy kinds of things are in place. I think much more likely next year we'll see a lot of turmoil. And it could be that causes interest rates to go up because people get spooked and lenders demand more for the money they're lending out because they're worried about getting their money back. So rates could rise, but it would be them going up for the wrong reason. And I think it's highly unlikely that the Fed is going to continue to raise interest rates in that kind of an environment. So, this is probably going to be looked back upon as one of those kind of fluky little things, the Fed starting to raise interest rates that turned out to be wrong and had to be backtracked relatively quickly. And so I think that's by the middle of 2016, that'll be the general opinion out in the world in general.
Now in Canada and the U.S., jobless numbers are so misleading because once your employment insurance runs out, you're no longer officially unemployed because you're not getting benefits for it. But how many people have given up looking for jobs or are doing things on the side the government doesn't know about?
Well, yeah, that's what happens in hard times is you get some distortions in your official statistics because a lot of people start working off the books. You can collect unemployment at the same time you work for cash for somebody else, and you make ends meet that way. And or you work in a seasonal business where they pay you cash and then you take the winter off or the summer off or whatever, depending on the season. And so you don't show up in the statistics the way you might if you just had a steady job. So in the U.S., yeah, we've seen a huge plunge in the labor participation rate. In other words, the number of adults that could be working, who are working, is lower as a proportion of the economy than it's ever been before. And they're having a lot of trouble explaining that because you can't just say, well, more people are retiring, because that's just a small part. And you can't say technology is throwing people out of work because they'd still show up. If they were made redundant by automation, they would still show up in the unemployment rolls. So it's not completely clear why so many people are dropping out, but it can't be a good thing. That's got to be an ominous trend that for the economy to be seen as truly healthy has to reverse. More and more people who are between 18 and 54 years old need to get back to work. And to the extent that we've had any increases in employment in the U.S., it's been, one, mostly people over 55 who wanted to retire but found out they didn't have enough money to retire, and two, people with other careers who can't get jobs within those careers taking jobs as waiters and waitresses and other kinds of service employees. So you combine those two trends, and it's really ominous because it means we're becoming a very different economy from what we were when lots of people worked in factories making real stuff and earning union wages. Those days are largely over, and it's been replaced with people who don't have any kind of job security, who aren't making very good money, and are just kind of getting by, And so something has to happen to reverse that if we're going to be a healthy system.
We'll have more with John Rubino right after the break.
See singing impressionist Andre Philippe Gagnon.
And I think to myself.
In Oliver, December 29th. In Kelowna, December 30th. Buy online and save at ontourtickets.com. Unbelievable harmonies, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band, Saturday, January 9th at the Alex Goulden Hall. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with John Rubino. John, you mentioned junk bonds, people not being paid. Is that going to go and escalate where all of a sudden countries like Italy, for example, produces something like 30% of the world's bonds, or they're the third largest. They're a huge player in the bond market. What happens when an Italy can't pay on its bonds?
Well, Italy is sort of the government version of a junk bond. They're a highly risky entity that shouldn't be able to borrow without paying way up because the odds of them being able to pay you back are kind of slim. But in this government credit bubble that we've got going, countries like Italy can borrow pretty cheaply, and so they've been borrowing huge amounts of money. And I think the assumption in Europe is that Germany's going to bail out somebody like Italy if they get in trouble. So when you buy an Italian bond, you're actually lending money to Germany. And so, if you have to only receive 1% on your bond, that's okay because you're going to be paid back by Angela Merkel at some point, and you'll definitely get your money back. But the concept of junk bonds in general is something that I think most people don't understand very well, because in late stages of credit bubbles, interest rates tend to be kind of low, and it's hard to generate income by buying risk-free stuff. So if you're a retiree and you used to think you were going to be able to live on bank CDs that paid you 6%, bank accounts, or really high-grade bond funds, and now you're finding out you get 1 or 2% at most in those instruments, you're being encouraged by your financial advisors to step up to high-yield bond funds, which are basically junk bonds, because they pay a little more. But what I think a lot of people don't understand is that those things are extremely risky, because the companies doing the borrowing are by definition highly risky. And that's fine in good times, because they can always get more money to refinance their old debt when it comes due. But in harder times, the credit window slams shut for junk borrowers, and they have to sink or swim based on their internal cash flow. And usually it's not sufficient. So you get a huge bust in the junk market. And so we're on the verge of that right now. Trillions of dollars were lent to frackers, the shale oil and shale gas companies, who were operating on the assumption of $100 a barrel oil and fairly expensive gas. Well, those things aren't there anymore, and so a lot of those companies are going bust. And that means the junk bond market is seeing rising defaults, which means junk bond mutual funds are not returning anything like they were expected to, and they're seeing a lot of people pull their money out. And so the funds themselves are becoming unstable. So we're on the verge of kind of a cascade failure of a big chunk of the junk bond market. And when that happens, that's $1 trillion or so wiped out of the global financial system, which is bad but not catastrophic. But the next effect is that people start looking around and saying, well, what's next? Man, if my oil bonds or my junk bond fund went out of business like this, what else could go out of business? What else do I have that I need to sell? And they start looking around, and then you get these dominoes falling. And that's when things get really dangerous. And so to come back to your original mention of Italy, the crappy country borrowers are going to be caught up in this at some point, where people look around and say, whoa, I've got Brazilian debt, or Italian debt, or Portuguese debt, and those guys probably can't pay me back if they're not bailed out. And what if they're not bailed out by Germany, and then they sell all that debt, and then the system really starts to spin out of control. So I would say that 2016 is a year in which that could very easily happen, since junk bonds are imploding as we speak, So we're not far from, or at least in prospect, we're not far from something like that beginning. And once it gets going, it's going to be really hard to stop.
Was England right not to join the euro craze that went across Europe and instead kept the pound?
Boy, I think they're glad they did, don't you?
Well, considering how much the pound is worth right now.
Yeah, and considering the fact that Britain has control over its own finances, which it wouldn't if it was part of the Eurozone. And it's not on the hook for Greece and Spain and Portugal and Italy as it would be if it was one of the stronger companies or countries in the Eurozone. Germany would be coming to them and saying, oh yeah, we're going to need an extra 100 billion pounds this month because otherwise Italy will implode. And so they don't have to deal with that now in Britain. So they should be really glad. I think they mostly are. And I think the debate within Britain right now is whether to even stay in the European Union.
Exactly. Well, I mean, their whole argument about keeping the pound was we don't want to end up supporting Spain, Portugal, Greece, Italy, all the southern European states, because they could see that they were in economic trouble a long time ago.
There's a great video of Margaret Thatcher debating this in the House of Commons, and she just looks like a genius right now. Because everything she said back then, that was well before all the crises that flowed out of the adoption of the euro had taken place. So she was just making predictions, and her predictions were right on, And so... Well,
they called her the Iron Lady for a reason.
Yep.
And a lot of the reforms in England, I know they were painful. There are still people who don't like it. But on the other hand, the subway system is clean, efficient, modern, and it was on its last legs. So having private partnerships with the government, or just pure having private companies take over, it really did make a difference, because if they could see a way to make money in it, they had a reason to keep it going.
Yeah. Yeah, I can't really say anything about British internal policy with certainty, but I am comfortable saying that they were probably right in keeping their own financial and monetary independence.
And they also have very good tax policies for startup businesses where they don't want you to pay any tax for a long time. They want you to get healthy first before you start forking money over to the government. Because they know small business is the biggest creator of jobs anywhere in the world.
Mm-hmm. Yeah, that seems very reasonable. And if that's the way they've set it up there, that's probably one reason for their relative success. Although, they've still taken on huge amounts of debt. It's not like Britain is a healthy system. It's just that they don't have some of the problems that the Eurozone countries have because they don't have this common currency that's fatally flawed. But to the extent that they've taken on huge amounts of debt and they have big real estate bubbles in London and elsewhere, they've got looming problems, just like the rest of the developed world. So they're going to have to deal with stuff in the future, but at least they're going to be dealing with it themselves. They aren't going to have some unelected bunch of bureaucrats in Brussels dictating terms to them. So they're going to have a better chance of succeeding than the average Eurozone country is.
Well, just as much as Americans revolted about having to obey British rules, the Brits don't like to obey European rules either. I mean, they were going to ban the double-decker bus because it doesn't meet European standards. But you still see double-deckers because the British put their foot down saying you can't do it. I mean, what tourist doesn't take a picture of a double-decker bus in front of Buckingham Palace or the Parliament buildings? It meant that much to them. So, yes, they don't like other people interfering in their affairs just as much as Americans don't like others interfering. In fact, Americans are pretty good at interfering in their own affairs. One thing I wanted to ask about is they've just approved the U.S. lifting any limits on exporting oil. Is that going to affect oil prices?
No. It might allow us to sell more oil overseas and might help our balance of trade a bit, but the oil market is basically global, and oil is a fungible asset. So to the extent that we're selling it overseas, that's just extra pressure, downward pressure on the oil markets overseas, and possibly a little bit less pressure in the U.S. So in the end, it all evens out. It doesn't matter where oil is being sold because it's just oil. It's all the same thing wherever it is being bought and sold. So I think it helps us make a little bit of money from our trading partners, but it doesn't affect the overall oil price at all. If there's an oversupply of oil today, there will still be an oversupply of oil next year when we're selling it on the open market. So I don't think it much matters. It's total output that matters and total demand. And as long as output exceeds demand, then there's going to be pressure on the price. And right now what's happening is we're using up all the storage. We're producing more oil than we're using, and we're running out of places to put it. So when we totally run out of places to put it, then the supply has to go down, and the only way to make the supply go down is for the price to plunge to a level that takes a lot of production off the market. So a lot of oil experts now are predicting, $30, $25 a barrel oil, which in turn would knock a lot of the marginal players out of the market. It would cause a lot of these fracking wells to close down, and that would lower the supply, which might bring things back into balance. But that's a 2016 story. It's not happening now as far as anybody can see.
Yeah, well, someone said the cure for low oil prices is low oil prices. But nobody wants to be the first one to shut off a tap.
No, but eventually your accountants make you do it if the price goes down far enough.
John, thanks a lot for chatting with us.
Sure thing, Jim. Enjoyed it.
Have the best of Christmas.
You too. Happy holidays, Merry Christmas, and I'll talk to you soon.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.